Hello, Nedu here. I would like to share a very simple trading strategy today with you. A lot of forex traders, of course, we have a statistics that just about 10% of forex traders are successful, okay, trading the market profitably. And I've, over the years, with some years of experience now, I've understood and realized that the best approach to trading the forex market is you keeping it simple. So I'm going to be sharing with you just a simple structural strategy on how you can trade in this. Anybody, whether you're a beginner trader or you're an experienced trader, you can use this to trade every day, just structurally. Okay, a few things I need to give you a background on. Number one is the concept of support and resistance. And of course, support and resistance, we have different types of support and resistance. I'll try as much as possible not to make this look so clumsy. But support area is an area that price maybe something like this zone now. It's really not a line, a zone, this area. For instance, you can see that for a very long time now, the market has been rejected around this area. Price been falling, and within this price range, it's been unable to break further down. So we can refer this as a support. So a price range, not a one-line price, a price range that keeps the market price from dropping further beyond that level. It can be seen as a floor of a house, okay, as just that can be your floor of where you are sitting. If you're watching this video sitting down, is just the support. All right, so you see market price dropped from this high. You can see it came all the way down here, moved back, return, moved back, return. This is a third time. This is a first, second, and third. Just this simple method. You'll have seen moved all the way. It was free falling. Of course, you know that price does not move linear. It moves in waves. 1, 2, 3, 4, 5. Right? Okay. Or you can also count here this way and down. If you know a little bit of Elliott wave, just know a little bit of every aspect of forex knowledge area, just a little bit, and build your strategy around what I'm going to be showing you today. Okay, so price has moved, say it's consistently moving in direction, it's trending, but it got to this point, something happened. It hit this level, pushed back up, it's rejected, returned back to this same level, okay, slightly lower, push back up, returned again. This is a third one. This is the first time, the second time, and this is a third time. And what happened after? You see, it started going up, and now it's giving you another linear, another wave, impulsive movement. Moved up, returned. This is a pullback. It pushed up, returned. It may likely get back to this same zone, this zone here. All right. It will likely get back to this same zone here before it can think of another movement in the bearish direction. All right, at least you can see what the price. So the moment you see this happen, it doesn't matter the time frame, whether it's 15 minutes time frame, 1 hour time frame, it will still work. Now this has happened. The next thing to do, this is what I usually would do, is to use my Fibonacci Retracement tool. Where is it? Okay, I'll pick the tool from this high to this low, the lowest of the lows to this low, because I'm getting ready to buy the market, seeing that this is a level of support. Market price has been rejected from dropping further. There could be some fundamental reasons why the price is rejected. You may really not care to know at this time, but something is happening fundamentally that is discouraging the bears, the sellers, all right, and the buyers are looking at taking over the markets. All right, so you can see, so this is one point, and now I'm using this Fibonacci Retracement tool, which is a very important tool that every forex trader must learn on how to use. I'm not here to tell more about it, but it gives you the various level of possible price pullbacks after an impulse. Okay, price makes impulse and then correction. If it's trending upward, it will make an impulse like this and it will correct. It will make another impulse and it will correct. It will make another impulse and it will correct. So we use the Fibonacci retracement tool to know the level of retracement. So price has moved from here to this point, for instance, okay? And now we want to know, because it will not continue to move in this direction. And before you start doing looking for a possible retracement, something must be happening around here. There must be some rejection of the price moving, back up, even though that underlying trend is bullish. But at this point, something is preventing it. There is a reason why it couldn't go up, and you are seeing those signs either with some of your candlesticks patterns or some other things, like maybe what happened here is it pushed down first, second, and third. So it could, something like that could happen here, or maybe a temporary reversal pattern of candles can show up here. Then you notice that market price is about to retrace. So you put your tool, your Fibonacci retracement tool, you pick it from here and drag it to that high. You will see these various levels of retracement. So these are the possible levels that the price will get to before it starts to go up. As simple as that is. I'm seeing price is moving in this direction, and it has made an impulse, and I'm seeing signs that the correction is about to start, and I want to take advantage of that correction by using my Fibonacci retracement tool to know exactly to what degree that it will retrace before it starts to go back up. All right, now let's apply it here. I saw this happen, and then these are the signs that this is a support, whether it's a strong support or it's just a temporary support, but it is a support because price has done a triple hit on that zone and could not penetrate. The only possible outcome is to move back in the previous, in the opposite direction. And this happened. We now decided to use our Fibonacci retracement tool from this high to the low, so we can know the level, because we're getting ready to buy, know the level that we can buy and target. And most times prices will retrace to 61.8%. between 50% and 61.8%. And it's important you know that most retracement happen between 50% and 61.8 retracement. So I could have seen all this, and there is this moving average I use. You can see this sky blue line here, this particular one. This is just so simple, something you can apply on your trading and grab some pips on daily basis as you tag along, okay, in your learning. Making it too confiscated, quoting different references, that can be a challenge. So try to eliminate every source of challenge. Keep it simple, keep your trading plan simple and easy to understand. So I put back my Fibonacci retracement tool here. All right, I'm looking at between 50 and 61%, which is around this zone. It's around here. So this is my zone for take profits. I'm beginning to 1, 2, 3 pushes down, price was rejected. You can see this candle here. This is another sign for the bulls to take over. You can see it. It's another sign for the bulls to take over. This is an engulfing candle. It's the strong bull candle. And I was telling you about the moving average 50 EMA is usually referred to as a trend indicator. Most trending markets, it doesn't matter the time frame, 15 minutes time frame, you see price usually will touch it and push away from it. I really don't know why, but it's been a historical observation. You can see here price touched it at this point. Let me pick this too. Okay, price touched it here and it pushed down. It touched it, slightly touched it here and it pushed down. You see, so here it moved up, and then you see when price moved below, closed below it, and went back to test it, it's the time to trade. Again here, look at what happened here. Price made these rejection signs. There are 3 of them, okay, which you can see as double bottom, maybe head, shoulder, head and shoulder, whatever. And then price has given us this candle. This 15 minutes time frame, I like taking my trades from the 15 minutes time frame. Looking at this, you can see this engulfed candle. You see, this is a bullish candle, totally engulfing several 1, 2, 3, 4, 5, 6 candles is a sign of bullish reversal, and at this time one could have entered a trade around this point. So this could be a very aggressive buy entry. If you missed at this point, you wait for the price to push back up. You can see pushed up to this level and come back to retest this 50-day moving average. So around this point, you could have also taken a trade, or you can also see these two candles here. See, this one totally engulfs this because market has been rejected here. So there's a reversal happening, which is not a trend, a long trend kind of reversal. Okay, you can see it, price has pushed 1 2 3, and then it's giving us another very important structure. So around this area, which is at 50 and 61, I'll be taking my profits, and that profits would have been how many pips? All right, so from here, if you took the trade from here up to this level, you would have made about 58 pips. 58 pips is a whole lot of money, okay? It's a whole lot of money, and then you get out of the market. So looking at structure, again, look at this. If you are looking at trading structurally and you are combining it with retracements, we have a typical Elliott wave structure which moves one wave. This is an impulse to, this is the first retracement, 3, then the fourth second retracement, and then is the fifth wave. Okay, now to give us an ABC retracement corrective structure here. Okay, this is a typical Elliott wave formation. All right, so we have wave 1, we have wave 2, which is this correction is from 0 to 1, we have wave 3, we have wave 4, we have wave 5. All right, and then this is A, this is B, and here is C. So we'll find the market making these kind of moves on daily basis. You can see this on 15 minutes time frame. If you're just looking at this on 15 minutes time frame, and make it a background theory for your strategy. All right, following this Elliott wave, price moves, this makes this impulse, and it retraces. This retracement can be 50%, that's 8.2%, or 1.8%, whatever it is. So you're just counting the way. Very simple. Keep it simple. Simple as that. You see. So after the fifth wave, market will do this correction. It will do this correction, and most likely, if the trend is continuing, what you will find is it will repeat the same thing again. It will come here, push up again, 1 2 3 4 and 5, before it will give you another ABC correction. All right, before it will do this again and now start to move up. But the thing is that you are following a pattern. This is how structurally price behaves. Structural price behavior, irrespective of what the fundamentals may be, you stand the chance of winning the market. And what are we doing? Under having an understanding of this structural move of price, and then combining it with the use of Fibonacci retracement, as simple as that is, Fibonacci retracement. So if I had seen these 5 moves, 1 2 3 4 and 5, all right, the fifth wave has completed, I can quickly come and take my Fibonacci retracement tool from down to the highest, okay, so that I'll be able to locate this C. Okay, and as you can see, this C, even with the freehand drawing, is exactly at 50.